how to do the benchmarking. Now friends, remember, world over, there are no standards for any of these ratios. Mota, there is a standard about the debt equity ratio. And what is the standard? And I'm going to discuss with you debt equity ratio, but I'm just telling you at this point in time. So the standard for the debt equity ratio is, if a manufacturing company goes to a bank or a financial institution asking for a loan, the bank will ask for a debt equity of 2:1. They will ask for a debt equity ratio of 2:1. That means what? That means equity must be twice the amount of debt. So if you are asking bank to give you a loan of 100 crore, the bank will say at least you must put an equity of 50 crore. So if you are asking for a debt of 100 crore, the bank will ask you कि भाई आपकी तरफ से 50 crore डालो. And when you do this, your debt equity becomes 2:1. Now, other than this, in my view, there are no standards. Okay, there is a standard about the current ratio. What is the ratio of the current ratio? The standard about the current ratio. If you go to a bank will ask your current ratio to be at least 1.33. They will be happy if it is more, but 1.33 is minimum that they will ask. But remember, that is from the bank's perspective. This debt equity ratio of 2:1 is from the lender's perspective. This current ratio of 1.33 is from the bank's perspective. From our perspective as the company, the current ratio must be as low as possible. And why it should be as low as possible, I'll discuss with you when I come to the current ratio. How to do the benchmarking? So number one, कैसे मालूम पड़े कि how my company is doing? I am telling you, मैं आपको बता रहा हूँ कि कोई ऐसा benchmark नहीं है, कोई ऐसा standard नहीं है, तो मालूम कैसे करें कि how this company is doing? There are 4 things that you can do. Number one, compare your current year's KPIs with your previous year's KPIs. तो आप चेक करें, what is your GP ratio for the current year? Compare it with last year. Current year's GP is 15%. Last year's GP was 17%. It will tell you how have you done in the current year in comparison to the last year. Current year's GP is 15%. Last year it was 13%. I'm sure it can again give you an idea that you have done better in this year than last year. Number two, what you can do, one is compare with the previous year. Number two, compare it with the budget. Remember, every company that you will be on the board of, they have a mandatory requirement to prepare a budget. So compare your all these KPIs with the budgeted number. That will give you an idea. So let's say if the budgeted net profit ratio was 10% and the actual net profit ratio is 11.5%, the company can give a big pat on its back. Why? Because company has exceeded the budgeted performance. That of course is a good sign. So second is compare with the budget. Third, what you can do is compare with your competitor. Remember, the companies on whose board you will be working mostly are going to be listed one. And since these companies are listed, their financials will be publicly available. So if you are say on the board of SBI, State Bank of India, you can calculate all these KPIs for State Bank of India and also for the SDFC. It will give you an idea as to how your bank, State Bank of India, is doing vis-a-vis SDFC. Or if you are on the board of Bajaj Auto, compare the numbers with the Hero, so that, or Honda. That will give you an idea as to how you are doing. So that is the third, compare with the competitor. Fourth is associations. So see, many of these business associations, whether it is ECMA or FICCI or CII or Indian Merchant Chamber or PHDCCI or Maratha Chamber of Commerce or CM. Now all these business organizations from time to time, they bring out the standard norms. So maybe you can compare, they bring out industry norms. So maybe you can compare your number with the business association. So this is how you can do the benchmarking to find out on all the parameters, all these parameters and the parameters that I'm going to discuss with you, how your business is faring currently, and that is what can be a basis. How to judge whether it's a good balance sheet or a bad balance sheet. So now we talk about the ratios that are based on the balance sheet. So number one, as we discussed, look at the reserves and surplus amount. Is that amount increasing year after year? Good sign. Number two, calculate a ratio, that is reserves to equity ratio. That means what? That means take the figure of reserves and surplus from the balance sheet and divided it by the figure of equity, which I am sure now you would remember. You call it equity, you call it you call it equity, or you call it shareholders fund, or you call it net worth. They all mean the same thing. And check this figure. So when you divide, jitna ye figure zyada hoga, it is so much better. So this ratio will give you an idea कि ये company already कितने times of its original capital flow back कर चुकी है business में. Third is the debt equity ratio. So you take the long term debt divided by the equity, and this will give you your debt equity ratio. As I was telling you, generally speaking, banks would not like this ratio to be more than 1. But as a business, you should not look at only the debt equity ratio. You should compare your debt with your EBITDA. Ultimately, what is important is whether your EBITDA is enough to support your debt servicing or to support your repayment of the debt. So you and I, as independent director, we are not the banker. So we need to look at how the company can grow more. So you link the borrowing with the EBITDA. Total assets to total liabilities. Yeah, total assets to total liabilities. So total assets would mean non-current assets plus current assets divided by non-current liabilities plus current liabilities. If this number is more than 1, that means company is solvent. If this number is less than 1, that means that business is not solvent. Current ratio. So I'm sure you will remember current assets divided it by current liabilities. This is your current ratio. So if a company has current assets of 200, current liabilities of 100, this company has a current ratio of 2. And then the working capital management. So the working capital management is reflected by your current ratio. And remember, working capital management is very, very crucial, very, very critical. And that is where you as an independent director must make your own dashboard, keep checking of this company. How is the working capital management? So is the company is locking more capital in the inventory, receivables? Bad sign. Company is reducing inventory and receivables, making profit. That of course is a good sign.